I'm going to be telling you from this slide forward is industry dependent, because from industry to industry, vary. So whereas a 20% return on investment might be good for my business, it may not be good for your business because you're expecting higher returns, you're in a different type of real estate that I'm in, you have lower fixed cost and overhead. Your return on investment, I would say, is 10% or higher, you're in a really good situation. And the way to most successfully impact you, to make it go from good to better to best, is really knowing your industry, knowing the specific standards in your industry, and knowing how do I manage those the best, keep them as low as possible while I further your expenses. Not only are you affecting your profitability, you're also affecting your return on investment and some of the other metrics that I'm going to show you in a minute. But don't fear, because even if your return on investment isn't at an industry standard, right? So all the different industry have standards. It's just a guideline that the banks use, finance companies use. You can always find ways to create the desired results by some of the things that we just mentioned. Second, it's not, okay. Okay, so weeks ago when I did the other, we talked about income, we talked about expenses, we talked about putting budgets together. All that coincides with every company that's in business is going to have to produce a balance sheet and an income statement.
Hey, Dan, I don't know if you can maybe dial in, but it's really getting bad with the internet connection. Dan? Can anyone hear me? What's happening?
Oh. Oh, yeah, yes, I can hear you.
I can hear you.
But Dan was breaking up.
Yeah, I can hear you, but yeah, he was breaking up pretty bad.
Okay. I'm like, it's the Twilight Zone going on.
Oh, actually, I thought you meant that we want to hear you in place of Dan. I was about to say no. I vote.
You know, that's a great idea, Sterling. Thanks.
Yeah, I'm sorry. I'm not sure what's going on. I have all 5 bars on my computer, so I'm not quite sure what's going on.
Pay your cable bill, Dan, your internet.
What's that?
Pay your internet bill.
Oh, it's all paid up. Trust me.
And then we may need to clear that throat chakra on your internet there. Clear that throat chakra.
Yeah, right. Exactly. So, all right, let me try to get through this so we don't have any more technical issues. So anyway, again, balance sheet, snapshot of the business at any point in time.
As soon as he started talking.
Dan, you might need to turn your video off. I think you might have too much broadway going on right now. Bandwidth.
Hey, and that porn that you got in the background, press stop on download until you get done.
We're recording, but once we finish recording, you already know we're coming for you, Sterling.
So
you know what it is? It's because we got all these H-Town people in here and it's chopped and screwed up in there.
H-Town in the house.
There you go. All right. So basically, there's a couple different things that a bank and a financial institution will look at when they look at your balance sheet. So they're going to look at your quick ratio, or what's commonly referred to as your asset test ratio. This basically tells the bank or the finance company whether you can pay your bills or not. There's a working capital ratio, which measures the company's financial strength. And there's a debt to equity ratio, which measures the company's financial leverage. Again, the quick acid test ratio, that's very telling. It doesn't matter what industry you're in, just like anything else, you have to be able to pay your bills. This will tell a finance company whether you're able to pay your bills. The working capital ratio and the debt to equity ratio, again, depending on your industry, might seem low to me in my industry, but it's high to you in your industry. And if you give me a second, I'll show you if I can get it. Give me 1 second. So this is a copy of a balance sheet, right? So the balance sheet is going to have your assets. So you're going to have what they call your current assets. And your current assets are anything that's easily convertible to cash. So as you can see here, checking, savings, security deposits accounts, right? Those are all cash because you can go to the bank and get them. Accounts receivable, we want to, right? People owe you. So in real estate world, people owe you rent, right? People owe you a wholesale fee, right? We expect to be able to collect on that. And then you get into your fixed assets. So if you own property, this happens to be a client of mine. I changed the name of the company and I changed the name of his accounts just so we can take a look at it here. But anyway, then you have your property, you have land, you have other assets, and then you have your liabilities. Your current liabilities are anything that is typically due and payable in 90 days or less. And it could be up to 12 months or less. And then you have your long-term liabilities. So in this case, he owns a bunch of property. So the long-term liability are the mortgages on the property. And then you get into some more advanced stuff that I'm not going to talk about tonight, which is members' equity and retained earnings. But net income, which we'll show you in a minute from the profit and loss statement, is the difference between the revenue that you generated and the expenses that you paid out. So in this scenario that we were just talking about, the quick ratio, basically what they do is they take the total, your total current assets, and they divide it by your total current liabilities. That number should be 1 or higher. That means that you can easily convert any of your short-term any of your short-term current assets into cash that can pay your liabilities. So if it's 1 or higher, you're good to go. If it's below 1, then depending on how far below 1 it is, it's meaning that you don't have enough cash or easily convertible assets that can be converted to cash to pay your existing debt. That's not good. Your working capital, the working capital here is nothing more than your total current assets minus your total current liabilities. So in this case, he has $24,000 more of assets than liabilities. Again, it's good because it's positive. And then the debt to equity ratio. So this debt to equity ratio, basically what it says is that it says for every dollar of revenue that I generate, for every dollar that I bring in, how much does it cost me to pay my bills, right? So you want to have it in most industries be less than 1, right? Because for every dollar I bring in, I only want to have to pay out 50 cents of that or 75 cents of that towards debt or towards liabilities. In this case, he's way over 1, but the reason he's way over 1 is because he bought all his properties and he financed them all. So the long-term debt that he has on his properties is what's really skewing that number. So from a financial institution's perspective, when they look at that, they'll take that into consideration. So then the next thing they would look at to judge the financial strength of his company, knowing that the debt to equity ratio is so high, is in terms of the long-term debt that he has on that property, how much of that how much equity does he actually have in those properties? So what I'll show you here is that he owns at the time that he bought the property, the time that it was actually placed on the balance sheet, his assets were $865,000. So he owns almost $1 million worth of buildings. The notes on those buildings are these right here. They're about $735,000. So the buildings that he bought when he bought them are worth a lot more than he owes on them. The other thing that the bank will do is they'll actually go and they'll get a current appraisal on those buildings. And actually, I know for a fact that he just did this because the market's so good, he was thinking about selling these buildings or not. So the building value appraisals actually came back at like 1.2 million, and he only owes 730,000. So if he was going to a bank to look for additional funding, they would probably take some kind of equity position in the building based on the latest appraisals. So that's why I'm saying it's some of these, if you look up the definition of some of these ratios, they could be deceiving depending on the industry that you're in. So let's go here. So the next thing we have is your income statement. Again, simply put, this is what are your total revenues minus your total expenses, and then did you bring in more money than you spent? And this is extremely important because this is based on the last class we showed you in the finance portion of it. You always want to make more than, right? It seems counterintuitive, right? Or it seems like it should be logical, but you always want to make sure you have more revenue coming in than expenses going out. Some banks, from being in the accounting world for 25 years, I argue with a lot of banks that the balance sheet is actually more indicative of the health of a company than the profit and loss statement, because the profit and loss statement can change drastically year over year depending on, what the market is doing. Whereas the profit and loss statement, you're only taking 12 months at a time, right? Because as soon as your fiscal year end hits, right, everything goes back to zero and you start over again. So a company may have a bad year from a profit and loss perspective, but like in this case, right, from a balance sheet perspective, this guy has $1.2 million worth of real estate assets and only owes, by the end of this year, probably only owes 700,000. So he'll have an equity position of $500,000. So even if his company was to lose $50,000 this year, he still has a very viable company, right? He may have lost the $50,000 this year because of, COVID and people not paying rent, or, not being able to rent out space because people don't have the money to start new businesses, whatever the case may be. So, but a lot of banks and most financial institutions and most private lenders, they will look at that profit and loss statement and simply look at, are you making money or are you not making money? Okay. There's a couple different metrics here for that they'll look at. They'll look at gross margin and they'll look at net margin. Gross margin, I'm really not going to get into too much because that has that's a function of your total net sales minus your cost of goods sold. In the real estate world, we really don't have a lot of cost of goods sold. So it's going to be, so most of our ratios that the banks are going to look at are going to be look at from a net profit margin. So basically it's net profit divided by total revenue. It tells you how much of each dollar earned results in profits, right? So in this same guy's business here, if we look at his income statement, right? And this is through June of this year, right? Looks like he did pretty good. He does some property management. He has some rental income. He had about $103,000 in income. And then we go through and we look at all of his expenses. And at the end of the day, he actually sold one of his properties. So he's generated a net income of roughly $40,000. Now, again, this is on paper. A lot of what goes, a couple items that go into your expense column, which are non-cash transactions, depreciation. He owns the buildings. He gets to take depreciation every year. It's a write-off on his tax return, right? There's an additional $16,000 there. So he actually, from a cash perspective, is doing really well. He's generated about $55,000 worth of cash in his business over a 6-month period of time, which is really good. And then because he did sell one of his properties, there's a couple expenses in here like closing costs and mortgage recording fees that typically wouldn't be in there. And actually, depending, I haven't looked at it fully, but we may be able to reclassify these expenses and write it off against his the profit on his sales. So those would go away as well. So if those did, then it could potentially, raise his net income another, $5,000 to $10,000. But I haven't gotten that far into it with him yet. But in his business right now, the way that it is, if you look at his total expenses divided by his total income, it's a net margin of 39%. That means for every dollar earned, he generates almost 40 cents in profit. That is fantastic. And again, when you take out depreciation, that raises it to 55%, which means for every dollar this guy generates in revenue, 55 cents of that goes to profit. And so that's a really healthy company. And then in terms of the margins, this is just a little example of why you have to look at the industry that you're talking about and actually get a full feeling of the company, is because I may be in an industry that has a 5% net margin, or have a business that has a 5% net margin versus another one that has a 25% net margin. And you might be like, dude, 5% compared to 25%? No way. Like, that's crazy. Your 5% stinks, right? However, if I have a $1 billion business with a 5% net margin, that means I've generated $5 million in revenue. Whereas if I have only a $10 million business, but a 25% net margin, I've only created 2.5 million in revenue. So banks will look at everything in your balance sheet and your profit and loss statement. They'll look at your industry, they'll look at your history. If you don't have a lot of history, don't worry about it. They're going to do some things to do the analysis, or help them with that final analysis to let them know how much of a risk you are and how much of a risk they're willing to take to, fund whatever transaction it is that you might be looking at. So with that, I believe that's the end of everything that I had. So I can definitely open it up to questions, or if there's questions that were in the chat that I missed from bouncing on and off, feel free, ask away, or Ashley or Marina, if you saw any questions in the chat, please go ahead.
I have a question, Dan. I mean, and I don't know if you can wrap it up this simply, but like, if you could give like the top 3 to 5 things, that every business just must have to be prepared for funding, and think of it from a newbie perspective, what do we need to start working on now?
All right. So from a newbie perspective, again, I'm going to assume that you're brand new. So the 5 things that you're going to, probably the top 3 to 5 things that you're going to want to have, you're going to want to have you're going to want to pull your own personal credit report and make sure that you're at least in the 700s. Reason being is, whether you're super brand new, or even if you've been in a business for a year or 2, depending on the type of loan and the size of the loan, they're still going to go back and look at your personal credit, and they may even have you personally guarantee the loan. So first and foremost is get your current credit report. And if there's anything that you have to clean up on your credit, clean it up on your credit before going to apply for that loan. Number 2 is, if you don't have one already, again, whether you're new or you've only been in business for a short time, put together a profit and loss statement and a balance sheet, so the bank knows that you know what you're doing, right? Because they don't want you just walking in there and they start asking you questions and you have no idea. And And it can be, again, it can be as simple as I said a couple of weeks ago. It can be something as simple as an Excel spreadsheet, as long as you have something. The third thing that you're going to want to have is you're going to want to have some kind of business plan. I'm not talking about having this big, long, like, 40-page business plan, but you're going to want to have some kind of business plan put in place where at a minimum, it tells what your company is, what you do, why you're different from your competition, how much money you think and how much revenue you're going to generate over the next 3 to 5 years, and how much profit you think you're going to generate over the next 3 to 5 years. And then the other thing that I would do, probably the last thing that I would do, is I would, if you're we're all in different markets for real estate, I would have an up-to-date analysis of your market, the trend in your market now, and what the experts in your market think the trend is going to be over the next 3 to 5 years. So if you have those different components, it'll show a couple different things. It'll show the bank that, number one, you're serious, number two, you did your homework, and number three, that they have something to work with. Because the last thing that a banker wants to do, especially with so many people requesting funding, is having to do too much of the work on their own. So the more work that you can get done for them, and the more questions you can ask for them up front without them having to ask you, the better your chances are going forward.
What other questions do you guys have? And it doesn't just have to be about real estate or about this presentation, but again, we have Dan, who is an awesome resource with 25 years of experience in accounting, 5 years in CFO level. What questions do you guys have about business, finance, accounting, or money?
Uh-oh, did I put everybody to sleep?
Yeah, I love that top 5 too. All right, well, if there aren't any questions for Dan at this time, he does have his email in the chat, so make sure you reach out if you do have some questions. And of course, if you have questions that you think of before we get off here, you are more than welcome to ask. But Dan, every time you come on, it's like one of my favorites, because finance is something that I feel like I'm always learning and always trying to grow in. And I feel like you're the only person who can explain it in English. So thank you.
No problem. Thanks. I've had a lot of practice.
Great job.
Thank you. Thank you.
Yes. All right, guys. Well, while we're still on, Sterling, are you going to be doing after hours today?
I don't know. I'll do it a little bit. I don't mind. I'll spend an hour. Talking real estate, marketing, whatever. Yeah, let's do it.
Let's do it.